Hi, this is Karim Rahimtullah, co-founder of The War Room, along with my partner Brian Bottarelli. In The War Room, we do a lot of stuff every day. We teach you stuff, we trade, do lots of trading, lots of winners. We do it all. And if you want to join us in The War Room, click on that link below. It takes you right to the site, explains everything that we do, and I hope to see you there. But before we get there, let's talk about something that's really, really important. This is called hedging. Hedging is kind of complicated, okay? So I'm going to take my time on this one, all right? When you hedge, like in real life, let's say you're hedging a bet, okay? What you're saying is that, okay, I hope it goes my way, but if it doesn't, I've got a backup plan. The simplest way to understand hedging is your home insurance or your car insurance. Why do you buy car insurance? Why do you buy home insurance? Well, if you've got a home that's worth $500,000, you're more than happy to send in a couple $1,000 a year because you know that if you get hit by a hurricane or a tornado or an earthquake or maybe even a sharknado, you've got money that's going to come your way to pay for the damage, right? So you put $2,000 in every year to cover yourself for $500,000 worth of damage. So that's a pretty sweet deal where you spend $2,000 and you're covered up to $500,000, okay? The same thing applies when you're trading. You've got a portfolio, or you've got a single stock, or you've got something where you're heavily invested. What happens if that trade goes against you? Well, for most people, nothing happens. They lose money, they start crying, and they're like, I'm never going to do this again. And then, of course, they do it the next day and they lose even more money because they didn't hedge properly. So when do you hedge? You only hedge if you've got something to hedge against, okay? There's no point putting on a hedge if you're not hedging against anything. Then it's just called a trade, okay? But this is a hedge. So this is what we do. So let's say you think the market's going to crash tomorrow. Ooh, boy, that would be really rough for a lot of people, right? Last time the market crashed, your portfolio went down, what, 30%, 40%? That's pretty serious, right? If you're holding a $100,000 portfolio, that's losing 30 or 40 grand in a couple days if it crashes. So you've got to protect yourself against this. So what do? There's several different things that you can do. The first thing you can do is you can buy an index put option. Okay? What's an index put option? Well, the index is something like the S&P 500 or the triple Qs, which measure the NASDAQ, right? So you go out there and you buy a put option on the entire index, right? Now remember what you did when you bought insurance for your house, right? You bought the insurance knowing that if your house went down in an earthquake, you get paid off, right? But if it didn't go down in an earthquake, what happened to that money? You kissed it goodbye, right? That's what a hedge is. If the market doesn't crash, you kiss that money goodbye, okay? It's that simple. That's what a hedge is. It's insurance. So for the entire market, for your portfolio of $100,000, you might spend $500 a month, in this case, because you think something's going to happen at some point in the next month. You spend $500 buying a put option on the index. So what happens if the index goes down? Well, what's supposed to happen in theory, and you might want to spend a couple $1,000s, is for every $10 your portfolio goes down, the hedge goes up $10, okay? So you're balancing it out, which is really critical. So you always need to have hedges if you think something bad is going to happen. And this kind of market that we've been in for the last 20 years, right? Something bad's always happening. So you always want to have a hedge if you're in the market. So you're basically saying, I'm going to give up, 0.25% of my return every single month to keep my portfolio hedged, or 0.5%. But here's the flip side. If the market doesn't crash, your hedge might go to zero, right? But the rest of your portfolio should go to the moon. So the rest of your portfolio's gains should more than cover what you lost in your hedge. That's what hedging is all about. So there's different ways you can hedge your portfolio. One way is buying a put option on an index. Let's say you own a lot of shares of a stock like Coca-Cola. It's coming out with earnings tomorrow. Well, you can buy a put option on Coca-Cola to protect yourself in case Coke goes down. That's called a married put. That's a hedge too. You can own gold. Why would you own gold? It's really heavy. Can't carry it around all over the place. Look, people say, hey, I'm going to buy 1,000,000 ounces of gold, all right, and protect myself. What are you going to protect yourself against? I bought 100 ounces of gold once, okay? 100 ounces of gold. I paid, I think, $280 an ounce for it a long time ago. I put that gold in my pocket, okay? My pants fell off. It's that heavy. So can you imagine having gold? You don't walk around with a bunch of gold, but there's a way you can do it in the market. You can buy put options or call options. In this case, you'd buy a call option, or you buy gold stocks or options on gold, because gold tends to act as it has an inverse relationship with the market. So when the market goes down, gold usually goes up. So that's another way you can hedge. Now, the last way you can hedge is by buying these leveraged ETFs. It's a little scary, so you really got to know what you're doing. The leveraged ETFs give you a bigger bang for your buck. So if the market goes down 10%, this leveraged ETF will go up 3 times that, or 2 times that, or 5 times that. Massive amounts. But they reset every single day. So you got to be really careful. They don't just continuously, go up in value. Now they do if you've got a trend that goes down every single day for like 2 months. But otherwise, think about it. If it went down every single day, or you could hedge your portfolio just by buying these leveraged ETFs, everybody would do it, and you wouldn't have to do anything else. Well, life's not that easy, right? It's a little bit more difficult than that. But the key thing to take away from this is if you've got stuff to hedge, hedge against it. Think about your house. You have a house, so you buy insurance. If you had no house, why would you buy insurance, right? If you have stocks, you buy insurance. Have no stocks, don't buy insurance. So there you have it. Everything you always wanted to know about hedges, but we're afraid to ask, okay? All in one segment. It's stuff like this that we talk about in the War Room and also in Trade of the Day, which is our daily publication. If you want to know more about it, click on the link below, take you right to the site, and that's where we give you lots of daily trading advice, stock tips, option tips, you name it, and I hope to see you there. Thanks a lot.